Okay, in this series of videos, we're going to take a look at content from Chapter 11, or just look at income properties and how we'd analyze the investment in those and the taxation of those properties. So let's jump in here to our presentation. So we're going to talk a little bit about some kind of qualitative things, some conceptual things, and then we're going to get into the nitty-gritty of really this class and look at some numbers, look at them in depth, look at how we would build a pro forma and make sense of the cash flows, layering in things like financing and taxes. So this is an intensive chapter, maybe the most important chapter, the most important topic of the semester. So you really need to focus in on this material. You may need to watch these videos twice or watch them slowly, take notes, digest this along the way, because I'm going to move through it rather quickly and in a logical, straightforward path. But it's unlikely that you will get all this the first time. I think it would help if you approach it in a logical fashion. That's the way I'm going to lay it out, in a very kind of piece by piece, straightforward, easy to understand sense. But once we start putting in all the details, it is going to become, or it can become, overwhelming if you're not staying on top of it. So you need to focus on this material, pay attention, get the big picture, and then think about the particulars that I'm walking through here. So we're going to start with looking at some reasons to invest in real estate. So in many ways, real estate investment and putting your money into real estate assets is no different than investing in any other asset class. Many investors are looking after cash flow, so they're trying to put money to work and generate a stream of passive income, a stream of income that's coming to them by virtue of their money and their investments that they've made. So we might call this the yield from the real estate investment, or a lot of times you might hear the term cash on cash. So if you invested some cash, that would be your denominator. So the invested cash, and then the income over the course of the year would be also some cash. So whenever you hear cash on cash, the cash in the numerator is the income that you're receiving. The cash in the denominator is the cash that you've invested to receive those. Really, it's almost like a dividend or a coupon payment on a bond, right? So that's one reason. We also might invest in real estate to appreciate, to gain from appreciation, or get the capital gain from the growth in the value of that real estate over time. So again, just like investing in a stock or potentially a bond, if interest rates are going down, bond prices go up. You gain by holding on to that bond. If you own a stock and the prospects for the company improve, the company does well, it's coming out with new products, etc., the stock price goes up and you gain by virtue of your investment in that company. So just like real estate, we would invest for cash flow and we would invest for appreciation. And importantly, and hopefully you understand this important notion in finance, your total return is going to be the sum of your income yield and your capital gains yield. So we would put those two pieces together. That's your total return for investment in that particular property, particular holding. So just as a quick and simple example, assume that you buy a building for $1 million and you put it all cash. You buy it all cash, so no financing right now. The property generates $50,000 of cash flow. That would be equal to a 5% yield, or a 5% cash on cash. Remember up here I talked about the cash on cash. The $50,000 of income would be your numerator. The $1 million of cash you invested in the property would be your denominator. So that little ding-a-ling-a-ling was someone wanting to sell me an auto warranty. I just spent the last 30 minutes buying it, or at least giving them my credit card information. I don't. It's supposed to come in the mail or something. So anyway, sorry about that little interruption. So if we, continuing our example, if we sold that property at the end of the year that we bought it, so let's say we bought it January 1, we collected $50,000 over the course of the year from running the property. And then at the end of the property, that thing was worth $1,070,000. We would have had a 7% capital gain by virtue of the appreciation. So our total return would have been the 5% cash on cash yield, or the 5% income yield, plus the 7% capital gains yield. So our total return would have been a 12% return on this property. Now, this is referred to as an unlevered return. So unlevered means we have no debt involved. And so anytime you hear unlevered, that means no debt. Levered or leveraged would mean we're going to stick some debt onto the property. And we're going to talk about financing, putting on debt, as we look at some cash flows later on in this series of videos. So let me keep moving here to the next slide and talk about some more reasons that we might invest in real estate. So as a finance student, you should also have other things in mind beyond just the expected return from investing in an asset, right? It's not just about returns. We also need to think about risk. We need to think about things like the correlation or the covariance of this asset that we're buying and how it relates to other assets, right? So we should be thinking in a portfolio context about really everything that we're doing with our money. So we need to think about things like asset allocation, et cetera, et cetera. So in the case of real estate, we'd be thinking about things like the diversification benefits that come from real estate. And that should say to the extent that real estate returns aren't highly correlated with other asset classes like stocks or bonds, then having real estate as part of our overall investment portfolio would reduce the overall risk in our investment portfolio, and that would be a beneficial thing, right? That would be a reason to invest in real estate. And then we've already kind of touched on some things in previous discussions, but there are some tax benefits associated with real estate. So the interest paid that is paid on real estate and on the loans that you have is tax deductible. You get a depreciation allowance that reduces your taxable income and the taxes that you pay. And you can also defer capital gains through the 1031 exchange. So we can really reduce the tax burden of our overall investment portfolio by putting some money in real estate that can help shelter some income elsewhere. And we can also postpone capital gains from the appreciation that we have in real estate if we pursue the 1031 exchange route. Well, let's move on here and talk about real estate market characteristics. So market conditions are super important for real estate investors, and it's a little bit tricky, a little bit different than what we might think of as the market conditions for other types of investments, for stock investing or bond investing, that sort of thing. We really need to hone in on the supply dynamics for real estate, for new square footage in the multifamily world, the office world, the retail world, etc. We need to pay attention to the demand drivers, and we've talked about those in previous videos. We need to know information about where occupancy is and where it's heading. We'd like to know what's going on with the rental rates. Are they increasing? Are they increasing at a high rate? We would like to know what tenants are out there looking for space, so the space requirements in our marketplace. If we have a huge employer moving to town and they're going to be bringing hundreds of new employees to town, they're going to be needing a new office space. There's going to be new demand for retail space. There's going to be a lot of housing demand, right, if we have sudden surge in job growth, etc. So we need to kind of pay attention to all these pieces and parts in our market. And I'm going to finish this first. Well, actually, before we jump into this cycle, I'm going to stop here. But in the second video, we're going to look at kind of a prototypical real estate market cycle and talk through these different phases of a cycle. So we'll talk about recovery and how things are getting better in the cycle as we move this way. We'll talk about a market peak, and then as we start to move down the market as things are getting a little bit worse, and we'll talk about what things look like at the trough. So let's stop here, and we will pick up with the real estate market cycle in video number 2. And so I will see you then.